does create that inequality, and that inequality is, I can do that, and that inequality results from this idea of the way scarcity is handled in the system. So the next question that we have to face is to say, well, okay, fine, this is Keynes. Keynes was talking about Britain in the 1920s. Britain in the 1920s was an industrialized country. What does this have to do with economic development? How in the world can we extend this analysis to developing countries? And the response is, well, we have a very strong hint, and this comes from Joan Robinson's concept of disguised unemployment, which V.K.R.V. Rao, a well-known Indian economist who also worked for a certain period of time in the United Nations and introduced disguised unemployment into most UN development documents, that this concept of disguised unemployment, if you look at it, is in fact, again, to turn it into traditional neoclassical terminology, which was done very quickly. And this is the idea of the negative marginal productivity of labor in agriculture. What is that? That is disguised unemployment. So we say, okay, we know that disguised unemployment has already been used in looking at development. How can we use that idea of disguised unemployment to analyze economic development? And without going into a long discourse, which does take some time because most everybody has either never read Joan's article on disguised unemployment, or if they did manage to read it, did not understand it. And I would argue that in order to understand it, you had to have been in Cambridge in the 1960s working on what was then called the Theories of Growth and Cambridge Theories of Growth and Development. That argument is one which looks at the ability to do what? Well, Joan talked about the ability to move people from less than full productivity occupations into occupations with higher levels of productivity. So the translation of this idea, and her argument was that you could always increase demand a little bit more, because if you could move the cab driver from the cab into an engineering job because he was a trained engineer, then output would expand because productivity would expand. So that what she was doing was playing with the limits on the policy of aggregate demand. Now, if you think of this not in terms of a cab driver going from running a cab to being an engineer, think of it from moving labor from agriculture to manufacturing. This is basically the way we started out the sort of Lewis arguments and the large number of development theories, which all look at moving labor from lower productivity to higher productivity occupations. And this gets us to what? Well, this gets us to the idea of manufacturing very quickly. We're in the theories of Prebisch. We're in the theories of the idea that you can use the transition to manufacturing as a way out of the problem of poverty in the midst of plenty, which is explicitly what happens when you're looking at an agricultural sector in which you have people who are not making any direct contribution to aggregate output. Now, this is more or less a well-known part of the theory. The part which is not so well known is that, well, look at this from 2 points of view. The one point of view is that this is a problem which always exists no matter your level of development. You take an agricultural economy, it can move to manufacturing. Why? Because technical progress in manufacturing is stronger than it is in agriculture. But unfortunately, in manufacturing, technical progress does what? Technical progress creates unemployment. So the development process becomes what? Development process becomes one of always trying to resolve the problem of excess labor, of always trying to resolve the problem of unemployment. Now, you can say this is an effective demand problem. Well, it's not only an effective demand problem, it's a problem of the sectoral composition of output, number one. And then secondly, it's a problem of financing that development. That is, how do you go about financing the transition from agriculture to manufacturing, or manufacturing to services, or wherever you manage to go in order to try and absorb what is always the fact that labor is exuberant. So the point that we're trying to make here is that it's not only, or it's not enough simply to identify the need to move into manufacturing. The problem is providing the way you finance the transition into manufacturing. And the question then becomes, do you borrow from abroad or do you build a domestic financial system? And this is the case where we're back to this question of scarcity. Implicitly, if you look at this idea that you have scarce resources, and the basic theories always tell us that developing countries are lacking in terms of domestic resources, then you have to borrow from abroad. On the other hand, if you recognize that finance is effectively created domestically, that is, every financial system always creates its domestic financial means, then it says that your focus probably should be not only on manufacturing, but also on developing a financial sector, which is going to support your manufacturing sector. You can't have one without the other. But if you look at the traditional theories of development with excess supplies or unlimited supplies of labor, you don't find any stories about financial institutions. You don't find any stories about financial structure. You don't find any stories about how going about that financing takes place. Now, having said that, you have a secondary problem. And the secondary problem is what? Well, the secondary problem is that even if you manage to build your own domestic financial sector in order to finance manufacturing, financial instability may in fact provide a constraint. That is, the system may produce financial crises. And if you look at the experience of many developing countries that have tried to use their domestic financial sector, starting, well, more recently from the crisis in the Southern Cone in the 1970s in Chile, and then subsequently in Argentina and so forth, you discover that even if you do manage to develop your own manufacturing sector, financial instability may provide a difficulty. And this is where we run into this, this problem of financial instability being a constraint. And it's a constraint why? It's a constraint basically because we believe we should be using measures in order to create financial stability. And that financial stability is what? Well, I'm jumping a little bit ahead of myself because this comes in the next slide, but financial stability means in general protecting your financial system. Protecting your financial system means what? Well, we're back to where we started out, protecting creditors. When you protect the financial system, you're always bailing out creditors, and you're shifting the costs where? You're shifting the costs again back to those people who are the debtors or in those sectors that are not receiving finance. The other alternative is that you can borrow from abroad. Okay, if you manage to borrow from abroad, then we have our well-known external account constraint. We know that borrowing from abroad requires repayment, and we know that the external account has been a major constraint in most development theories. Now, the point that we're trying to make here is that, in fact, you have two constraints. One is a financing constraint, and the other is the potential external account constraint. Okay, so bottom line, building manufacturing or using this idea of development as the shift of resources from lower to higher productivity occupations in order to absorb unemployment as the system expands, you always require building a domestic financial sector, and it requires building export capacity one way or the other if you're going to deal with these constraints. Now, the other thing is that if you look at the criticism of this approach, we find, well, import substitution. This is terrible. Import substitution requires rent seeking. It requires some sort of inefficiencies. And I look at this and I say, well, if you accept that development comes about by building up a manufacturing sector, tell me how this is not import substitution. They are one and the same thing. By definition, if you are going to be changing the sectoral composition of your output in order to build up a higher level of productivity by shifting labor into manufacturing, by definition, you're going to end up with import substitution. And the same thing, you can say, well, you guys are not, this is not a theory that looks upon comparative advantage. No, yes, it is a theory that works on comparative advantage. It doesn't simply mean that we're going to be specializing in bananas. We're going to be specializing in manufacturing where we can absorb the excess labor. The labor, the resource that developing countries have in general is excess labor. So by definition, this is a comparative advantage. Developing countries have a comparative advantage in certain areas of manufacturing because of excess labor and because of relative labor costs. So this is a sort of the background argument that I'm attempting to use, is to say, it depends very much on how we choose to describe what's going on here. On the one hand, you can look at it as being positive. On the other hand, it turns out that it looks like it's being relatively against the mainstream. Now we come to the second part, and this is the implicit stability constraint in inequality. Okay. Now, if we look at financial stability is what? Well, basically, financial stability means what Minsky talked about in terms of validating credit, that is, paying up on your debt. And then we have Keynes, who comes along and says equilibrium is blither. Okay, what is financial stability? Financial stability is a definition of equilibrium. Okay, it's an equilibrium that is required in the financial system in order to make sure that all creditors receive their full benefits. Now, we've already seen that in Keynes theory, this doesn't happen. An alternative way of looking at this is what Minsky called the two masters of regulation. Okay, the two masters of regulation are what? Now, Minsky said, if you look, you want the financial system to do what? You want the financial system, first of all, to provide a safe and secure means of payment and means of storing value, of saving. Okay, now to do that, we need equilibrium. Okay, we need the fact that all debts are repaid to creditors. On the other hand, the other side of the financial system, Minsky argues, is to do what? Well, it's to finance that transition to higher levels of productivity. It is supposed to be taking risks. The financial system is there in order to finance risky undertakings. Okay? Now, a risky undertaking is what? A risky undertaking is an undertaking that has risk, which means that some of them do not work. So that if you look at financial stability, or you look at the financial system, now go back to our balance sheets, we know that the basic rule of accounting is that credits and debits must always balance, that balance sheets must always have assets and liabilities. So if we look at a sort of simple representation of the financial system, where is the risk of financing new innovation? Well, that risk is in the asset side of the bank balance sheet. Where is the zero risk, perfectly certain payments? Those are all on the liability side. So if we're going to have equilibrium, and if we're going to have financial stability, it means the value of the asset must always equal the value of the liability. But we've just said that some of those assets are risky. Some of those are going to fail. If they don't fail, what happens? Well, equilibrium is not maintained. Something has to happen in order to restore the system to equilibrium. Now, how do we do that? Well, again, this is part of my argument, is that implicitly, as long as you're using a system which attempts to defend, Minsky would call it the preference for one of the masters of regulation, the masters of regulation in general tend to be prudential regulation that ensures the liability side, while it leaves the asset side more or less to fend for itself. So if we look at the way we ensure financial stability, what do we have? We have deposit insurance. Deposit insurance defends what? Deposit insurance defends people who are holding the liabilities of the system. Okay, so if you've got your bank deposit, it says yes, your bank deposit is fine. On the other hand, it says that somehow or other, those assets, which are the liabilities of what? Well, these are the liabilities of those people who borrowed money from the banks in order to provide unemployment. Those are the ones, in general, that we do not support. In the case of crisis bailouts, what do? We support the financial institution. That is, we bail out the bank rather than bailing out the institutions that provide employment. So in general, what happens? In general, what is going to happen is that if you're preserving financial regulation, if you're preserving the system of the master of safe and secure payments, it means that you're not preserving the master that provides the transition and that provides the support for employment and the expansion in the system. Now, what I would argue is that this implicitly creates a very sharp inequality. That is, there are some people in the system who are defended, some people who are not. And this is a natural part of the preference that we have for financial stability over employment stability. Okay? Now, we have insurance mechanisms, we have bailout mechanisms for financial institutions, we have them for banks. Do we have them for labor? Well, we have, after a great fight, a certain amount of employment insurance, but if we look at the way Minsky recommended analyzing this differentiation between these two masters in the financial system, he had two possibilities. One possibility said, why don't we have, instead of deposit insurance, why don't we have insurance for the creation of employment? That is, the institutions, the assets that are held by the banks, why don't we have insurance for the assets? So that if it turns out that a business firm doesn't manage to meet its payments to the bank, that the government intervenes and bails out the firm rather than bailing out the bank. Well, we know that this is supposed to be inefficient. Okay, this is again this question of language. When I was living in England, it was very popular for the Wilson government to bail out the automobile sector. Okay, it was seen to be completely inefficient. But if you look at it from this point of view, you should ask yourself, is it more efficient to bail out the financial institution, or is it more efficient to bail out the automobile sector, which provides employment? Under labor governments of that period, the decision was that it was important to provide bailouts to both. Now, the alternative that Minsky gives us, he says, okay, what we have is the possibility of what he called employment of last resort. The government can step in and substitute. If we really want those inefficient businesses to go bankrupt, if we want those assets not to be supported on the bank's balance sheet, we can allow the government to come in and provide employment. Why? Because, as Keynes tells us, the government is not required to meet a shareholder profit return. What its return is to look at the overall level of employment. Okay, so this is sort of the first example of this idea of trying to look at financial instability from a broader perspective, and the fact that while we always think that financial stability is a good thing, particular, if we look at the presentation of Minsky's theory, this is always, well, financial instability is bad. No, yes, financial instability is bad, but certain kinds of financial stability, in fact, are just as bad, because it's the the idea of preserving financial stability which produces the justification for arguments of non-intervention in labor markets and non-intervention in support of development. Second point is that if we look at official post-war development strategies, almost all of them talk about development as being something that is financed by savings or finance flowing from developed to developing countries. Okay, still today, the United Nations has the idea that there should be at least, well, 1% was the first target. It became 0.7 after Tinbergen discovered that there was a 0.3% private sector financing, but the idea was that we should have financing, capital market financing from, official development financing from developed to developing countries. Then, if we take the neoclassical approach, Jacob Viner, who was a architect of the international financial system, argued very strongly in favor of allowing international private market capital flows to do the financing on the basis of rate of return differential. It's a very nice article, which I have my students read, that Viner wrote in 47, I believe, arguing that because the capital scarcity of developing countries, that is the lack of resources, would produce a marginal productivity of capital that was higher in developing countries than in developed countries, that international capital markets would automatically allocate from developed to developing countries. Now, we know from the Cambridge controversies that this theory simply does not hold. This theory was well known already in the 1950s, but at that very same time, we continued to argue that the development problems would be solved by moving funds from developed to developing countries, when there was absolutely no theoretical basis for it. It's very interesting that if you look in the diaries that James Mead kept when he was working with Keynes in setting up the post-war financial system, you find this very interesting quote. Keynes gave us, by way of a digression, a marvelous proof of the fact that international investment always has been and always should be defaulted. And if we look at the experience of transferring funds from developed to developing countries, part of my experience working in the UN was to produce the UN report on the net transfer of financial resources from developed to developing countries. We discover that in only a very few periods of history has this in fact been the case. That is, in general, resources have gone from developing to developed countries. So that despite the fact that we know that this was a policy which historically did not work, that theoretically could not work, we continued to support that theory. You can think of this as a bit of cognitive dissonance in terms of the development community. We believe that this is how it should have worked. In fact, it never did, but we continue to do so. And again, this brings us back to our argument is that probably if we're looking at the choice between external and internal financing, it's the development of the domestic financial sector which should be important. Okay. Now, if we go to the last point, let's look at international financial stability, Bretton Woods and stable exchange rates. Okay. If we think of stable exchange rates, they're a good thing. Why? Well, in the interwar period, we had beggar my neighbor policies. We had all sorts of instability, which was caused by exchange rates being extremely volatile. So the idea is that stable exchange rates, just like stable prices, are informationally efficient. This is about the only reason I can think of why you would want to have price stability. This is the monetarist argument that if you have excessively volatile prices, then it distorts the efficient allocation of resources. Presumably, the same thing was true in Bretton Woods. But if you think of stable exchange rates, what does stable exchange rates mean? Implicitly, or I should have said explicitly, this means that countries should have balanced external accounts. That is, if you're going to have a stable exchange rate, it means that claims on your country should be balanced by your claims on the rest of the world, so that you can exchange currencies at a fixed or stable exchange rate. Now, let's think about this. This is 1940. The official development financing position that we just discussed was developed in the 1950s. So at the same time, in the United Nations, okay, the United Nations was arguing in favor of net transfers of resources from developed to developing countries at the same time as the UN specialized agencies, particularly the IMF, was arguing that countries should have balanced external accounts. Now, let's think about our external accounts. If you have net capital flows from developed to developing countries, then it means that implicitly your current accounts are going to be unbalanced. If developing countries are borrowing from abroad, then it means that by definition, they are going to be having balance of payment external deficit. So that the entire policy of net transfers was a policy of imbalances in external accounts, and this meant that by definition, countries would have difficulty in stabilizing their exchange rate. And what did we discover? We discover, in fact, that this was precisely the case. Eventually, the stable exchange rate system broke down because of the impact of private market capital flows creating excessive imbalances. Again, cognitive dissonance. If you say to a developing country that we believe you should be developing by borrowing from abroad, you're also telling them that we believe you should be running an external deficit. But we're not willing to finance that external deficit because it creates instability in the exchange rate. So what do? We create the IMF. What does the IMF do? The IMF creates the possibility of a developing country running an external deficit, but only an external deficit which the IMF finances in exchange for a policy to eliminate that external deficit and to return to equilibrium. So that by definition, if you believe that development financing should be a capital flow from developed to developing countries, by definition, the system is incompatible. Okay? Developing countries simply cannot do this because if the imbalance becomes too great, they're required to go to the IMF. They go to the IMF to borrow. The IMF then comes to them and says, look, you're going to reduce domestic absorption. You're going to reduce the expansion of domestic financing, and you're going to stop growing. And you're going to stop growing at a sufficient amount in order to restore your stable equilibrium. This is the first problem. The second problem is that the stable exchange rates, number one, are in general incompatible with building manufacturing. There's an entire literature starting with Prebisch, supported by Calder, Marcel Diamand, who, if you have never heard of him, I recommend that you look at, probably one of the most insightful of the Argentinian economists, dealing with terms of trade, as well as Singer, Myrdal, and others on the terms of trade, arguing that if you are going to be building up your manufacturing sector is always going to be subject to a competitive disadvantage. How can you overcome that competitive disadvantage? You can overcome that competitive disadvantage with multiple exchange rates. Okay, all of these people recommended dual exchange rates, an exchange rate for primary commodities and an exchange rate for manufacturing. The IMF refused the possibility of multiple exchange rates. Why? Well, there are a number of reasons, and I won't go into all of them, but basically it was again a question of inefficiency. Clearly, we had experiences of multiple exchange rates. None of them were operated efficiently. This is where Diamand comes in as being very, very relevant in terms of criticizing. So if we look at this idea, basically international imbalances probably should be the normal characteristic of a global economy in which there is catching up between developed and developing economies. Here's the question of the flying geese. Precisely what is the flying geese system? A flying geese system is a system in which you have imbalances across developed and developing countries. On the other hand, we have an international financial system which attempts to support international stability, and that international stability, in fact, has a net constraint. So we have all of these things in which we start out, and if you think of it, the bottom line is we're back to Keynes' equilibrium is blizzard. Okay, all of these systems are imposing equilibrium on a system which probably should be out of equilibrium. It should be in imbalance. Okay, flying geese is a system of what? It's a system of global equilibrium, but individual sectoral imbalance. The same thing with financial instability. So the question is, what system would be more appropriate? Okay. Now, this is why we have this difficulty with the IMF. As long as the IMF becomes a lender, okay, the IMF plays exactly the same role as a private bank that we've talked about in terms of the domestic financial system. It provides, the IMF does what? It provides reserves, it provides loans. So that what it's doing is providing a loan directly to a developing country, and the developing country has to pay that loan back, okay? And it's always this one-for-one balance. I'm borrowing from the IMF, I'm borrowing, whether it's I'm borrowing dollars or whatever I'm borrowing, doesn't make that much difference. It's always a question, again, of having this debtor-creditor relationship and the necessity of reestablishing equilibrium. If we look at the Keynes system, and this builds on a current idea that I've been working on. Felix, how much time have I still got?
I don't think I think we normally keep them to an hour, so I'd say like another few minutes. I think you're fine.
Okay, so because I'm just finishing up here with the last.
Yeah, that's absolutely fine. Okay. Perfect. Thank you.
So the argument is that if you look at the Keynesian system or the Keynesian proposal at Bretton Woods, Keynes did provide an alternative. He provided an alternative that in fact was not necessarily what came to be the case, that was the imposition of what was the US financial system or the US financial sector on the global level. Now, this starts out from Keynes's throwaway comment that he made at the christening of the Bretton Woods system. He said, "I shall always hold the view that the christening has been badly done, that the names of the twins should have been reversed. Okay, that the bank should have been a bank and the fund should have been a fund." Okay, fund. Why was it called a fund? Well, quickly, bottom line, Dexter White, who was the main architect, along with Jacob Weiner, of the US proposal, had all grown up under the Exchange Stabilization Fund, created during the Roosevelt administration when the US went off cold. It was a fund that was set to stabilize the exchange rate when Roosevelt decided that he didn't want to devalue or revalue, possibility, the currency. It was patterned after the British Exchange Equalization Account of 1932, and these are funds. Okay, these are what we call price fixing arrangements. You can think of these as buffer stocks for currency. Okay? So they were basically something that was rather different from the gold standard. The argument was that we're going to reproduce the gold standard, but they didn't. The gold standard, nobody, no government, no central banks directly intervened in order to set exchange rates. What was set was the domestic currency content of gold, and then the market was manipulated in order to keep exchange rates reasonably stable. So the idea was that the fund should be set up in order to keep exchange rates stable by using, as I say, the equivalent of this buffer stock idea. Now, what is a bank? Okay, banks create purchasing power. They create means of payment. If we go back to the 1920s, well, even earlier, the end of the 1800s, the beginning of the 1900s, you can read virtually any economist. I cite here Hartley Withers, well-known financial journalist in 1906. Banks manufacture money. Okay, now we like to say loans create deposits. Okay, it's a bit galling that the Bank of England, that the Bundesbank, and several other central banks in the last 4 or 5 years have rediscovered the fact that loans create deposits. It has always been the case amongst individuals who understood the economics of banking that loans create deposits. So that if we look at this particular idea of a bank, loans create deposits. Why? Because this is how the banks, as Minsky would say, accept the liabilities of people providing production and employment and convert them into means of payment. This system in the United States was what? Well, this was a system in the United States in which banks held reserves to make sure that those deposits always had a stable rate of exchange between those deposits and government currency. It's the equivalent of fixing the price 1-to-1 between deposits and US dollar bills. Okay, so here is the bank using what? Using, again, the idea of a fund, and that fund are the reserves. The central bank is created to do what? The central bank is created in order to provide those reserves if they need to do so in order to validate those deposits. So if you remember where we started out, we said that implicitly the idea of stability of the domestic financial system requires preference for creditors. We now have the system in which the central bank provides that support, and the IMF becomes what? Well, the IMF becomes the thing which supports that system. And this is why Keynes said, what you've really done is not to set up a fund, you've just set up a bank, but that bank is an American bank. The bank is the bank that central bank that holds reserves and validates the deposit of that bank. Now, Keynes' alternative was based on an analogy with a completely different domestic banking system. Okay, Keynes talked about the banking system, or sorry, the banking principle. Okay, the banking principle is what? Well, if we go back to the monetary debate of the 1800s, Ricardo had already noticed that the various operations of banking in which money is merely setting off of one account and added to another so that payments could be made without the need of physical money or paper notes became the most economical mode of affecting our payments. Okay, that you could do this without actually having money. That all you needed was a system of debits and credits run by, well, a banker running his balance sheet or a banker running his clearinghouse. And precisely this is what Keynes proposed. That is the idea that you could have a global bookkeeper, and that global bookkeeper could simply set up debits and credits so that the financing which you needed in order to provide development could be held on the books as a debit against the credit of somebody else in the system. Okay? Now, this meant that you would escape from this basic preference for creditors and this basic preference for debtors. You've heard of the idea of asymmetric international adjustment. I'm simply recasting that idea of asymmetric international adjustment into the idea of symmetric treatment of creditors and debtors. If the developing countries are debtors, then the developed countries can become creditors, and they do not have to worry about the value of those loans. They don't need reserves to support them. All they need is an incentive in order to continue to hold them. And if you look at Shoemaker's proposal for the system, Shoemaker goes one step beyond Keynes. And he says, in fact, if you think of this, if you think of a credit of a developed country financing a developing country, instead of looking at the condition of that country, okay, say for example, you're Germany and you're financing Greece, instead of becoming very concerned because Greeks are never going to be able to pay back the money that you're lending to them, in a currency union, Germany is a creditor to the entire union. It's not a creditor to an individual borrower. And it can use those credits to make purchases from anybody else in the union, so that you've eliminated this problem of requiring specific reserves against specific credit risk. And this was the argument which Keynes used to argue that this would be a much more efficient system of providing international development financing and lifting the external constraints. Okay, I think we've gone now almost to 40 minutes, and this is more or less what we had agreed that they would do. I'm sorry, we covered a lot of things, as you say. These are things which normally we go into in a much greater detail. But the point that I'm trying to put forward to you is that, you know, if you look underneath the terminology, there's usually a very different way of interpreting what you're talking about. And much of the discussions that we have are these implicit acceptances of the idea of things which we think we are good. We think are good because we've not gone deep enough in analyzing their direct implications for the system. Okay, Felix, I guess, or Chris, I don't know who is going to.
No, don't worry. Thank you so much, Professor Kregel. That was fantastic. I really, really enjoyed that. I am going to pass over to Chris for the Q&A, if that's okay. I'm going to pause the recording, so please feel free to put your hands up, to jump in with your questions, to ask them however you like, really. Thank you again.